Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. What we have got here today is a practice question for depreciation of non-current assets. You will learn to calculate the accumulated depreciation for each of the 3 years involved in this question and also calculate the gain or loss on the sale of a non-current asset. You will see the question on the left-hand side of your screen, and on the right-hand side, we have all the workings which I'll go through step by step. What I need you to do now is focus and follow through for an excellent understanding because this is a very important topic for your exams. So with that being said, let's begin. Archie's gift shop started operation on 1 August 2014, selling gift items. The following information relates to expenditures on her office equipment comprising of printers and computers. So in the first information that we're given here, we understand that on the 15th of September 2014, we purchased two computers at a cost of $8,500 each. Okay, so the key word here is each. I'm going to highlight that. On 12 March 2017, one of the computers was sold at $3,500 to Lee Electronics. On the same day, a replacement computer was bought for $10,800. So based on the second line of information that we're given, we have two important dates. The first one being the 12th of March 2017, when we sold one of the computers for $3,500, and then on that same day, which is again the 12th of March 2017, we purchased a new computer for $10,800. The third line of information says the business depreciates office equipment, which are basically your computers and printers, at 20% per annum using the reducing balance method. A full year's depreciation is charged in the year of purchase and also the year of sale. The requirement of the question is to calculate the accumulated depreciation of office equipment for each of the 3 years, all right, ending 31 July 2015, 31 July 2016, and 31 July 2017. And then you also need to calculate the gain or loss on the sale of office equipment on 12th of March 2017. So let's look into the workings on the right-hand side. So we understand that we are working with the business when the financial year typically starts on 1 August of a given year and ends on 31 July of the following year. Okay? And this is also validated based on the first line of the question, which clearly mentions that Archie's gift shop started operations on 1 August 2014. Okay, and also in the requirement given in the question, it says for each of the 3 years ending 31 July 2015. So it's logical to say that the financial year starts on 1 August and ends on 31 July. Okay, now we understand that on the 15th of September 2014, based on the first line of information, which is the table you can see, we purchased two computers, and each of those computers had a cost of $8,500. Also, based on the third line of information, we understand that we apply a full depreciation in the year of purchase. So, in the first year of usage for these computers, the first year would start on 15th of September 2014, which is the day of purchase, and end on 31 July 2015, which is the end of the financial year of the business. Now, based on the company's policy, we will be applying a full depreciation, but we are calculating the numbers here now for one asset, just so we can avoid complications, because if you know the number for one of these assets, you can easily find the total amount for both of these assets combined because they all have the same depreciation policy, the same cost, and the same depreciation method, right? So just to simplify, we will assume that we are calculating for one asset at the moment. So the cost of one of these assets was 8,500, all right? And we are applying a full depreciation the year of purchase, starting 15th of September 2014 and ending 31 July 2015. So in the year of purchase, the full depreciation is calculated by multiplying the given percentage with the original cost. The given percentage is 20, and the original cost is 8,500, which gives us a full depreciation of $1,700 in year one for one asset only, okay? Now, I always recommend you calculate the net book value at the end of the financial year every time you're using the reducing balance method. So the net book value at 31 July 2015, which is the end of the first year of usage, is simply the difference between the cost and the accumulated depreciation. The accumulated depreciation is also synonymous to total depreciation. Because we are in the first year of usage, the accumulated depreciation can only be the depreciation expense of $1,700, which we had derived for the first year, all right? And the original cost, as you know, for one of these assets is 8,500. So the net book value is calculated as the difference between 8,500 and 1,700, which is 1,600. All right, and that's obviously valid for one asset because all these calculations were done for one asset only. Now, as I've mentioned before, we can easily find the total amounts for both the assets combined because they have the same depreciation method, same depreciation policy, and also the same cost and also the same purchase date. All right. So the total depreciation for two assets or two computers, which have the same cost of 8,500, would be basically $1,700 for one of these assets multiplied by two, which would be $3,400. So this is the accumulated depreciation for office equipment for the first year ending 31 July 2015. Okay, so that answers some parts of the question. All right. Now, let's move to year two. Year two, as we understand, will start on 1 August 2015 and end on 31 July 2016. Okay? And in between this year two, in between these 12 months that we've got in year two, we are confident in saying that we haven't purchased any non-current asset, nor have we sold any non-current asset. Okay? Now, we will calculate depreciation again for one of these assets only, just to avoid complications and simplify everything. So the depreciation for one of these assets using the reducing balance method, when you move to year two, is basically the given percentage multiplied with the net book value. And that was the main purpose of me recommending you earlier to always calculate the net book value at the end of any given financial year, okay, using the reducing balance method. So percentage multiplied with the net book value, the percentage is 20%, okay, and the net book value is $6,800, which we calculated for one of these assets at the end of year one, okay. So that gives us a depreciation for one of these assets to be $1,360, okay, for year two. Again, we want to find the net book value at the end of year two, which is at 31 July 2016. And we understand the formula for net book value is the difference between the cost and the accumulated depreciation, which is obviously true. But you can also simplify this. If you are in year two or year three, you can just simplify the net book value at end of year two by taking the net book value you had before at end of year one, which would have already accounted for the adjustment for depreciation in that particular year, minus the new depreciation expense of $1,360, which we have calculated for year two, and that would give us a net book value of $5,440. And obviously, this is valid for one asset. Okay. Now, again, we can just easily calculate the total accumulated depreciation for two assets combined for the financial year ending 31 July 2016. Okay. That is going to be $1,360 for one of these assets multiplied by two, which is $2,720. Okay. Now, So this is what we will report as the depreciation expense amount of $2,720 when you prepare the statement of financial performance or the income statement. Okay. But if you want to report the accumulated depreciation at the end of 31 July 2016 or at any given point in time is basically all the depreciation that we had so far for this particular group of assets. Okay? All right. So accumulated depreciation would have been 3,400 from the first year plus an additional 2,720, which would give us $6,120. And accumulated depreciation is something that we report in the balance sheet. You will see in the balance sheet at the very beginning when we have the section for non-current assets. Non-current assets are reported in 3 columns, starting with the original cost. Then we have got the accumulated depreciation, followed by the net book value. So within that second column of accumulated depreciation for non-current assets, you would be reporting 6,120, which is the total of all numbers we have got since the day of purchase of these assets, which is 15 September 2014. But when you are preparing the statement of financial performance for the year ending 31 July 2016, also known as the income statement for the year ending 31 July 2016, the expense amount for depreciation which you will report for office equipment is going to be $2,720, which is basically the figure valid for this year itself. Okay, so I believe you understand the difference between the total depreciation expense, which we report in the income statement or the statement of financial performance, and the accumulated depreciation, which you report in the balance sheet or the statement of financial position. Okay, all right. Now let's move to the third year of calculation. The third year of calculation. So we'll start from 1 August 2016 and end on 31 July 2017. And if you recall, the second line of information given in the question right underneath the table clearly specifies that on the 12th of March, one of the computers was sold, and also on that same day, a replacement computer was bought. Okay? So we first want to find the depreciation for the computer which we have sold. So that's why I have created a subheading here, disposal or sale of computer. So you want to find the full depreciation for this computer in year 3 as well, because the third line of information or the very last line that we are given in this question clearly specifies full year of depreciation in the year of purchase and also the year of sale. Okay? So the full depreciation in this case is simply percentage multiplied with the net book value, and we know that we have sold one of the computers, so the percentage is 20, and the net book value for one of these computers was 5,440 at the end of year 2, if you recall. All right, and that gives us a full depreciation of 1,088 for this computer which we have sold. Okay, and we also want to find the net book value after this full depreciation has been adjusted for, which is simply the net book value we had at end of year 2 or at 31 July 2016, which is 5,440 minus the new depreciation expense of 1,088, which we have just calculated, and that gives us 4,352 as the net book value. Okay. Now, I also want to calculate the loss or gain on disposal right now. So the disposal proceeds, which refers to the amount we have received by selling the computer, is 3,500, which the question clearly mentions in the second line of information underneath the table. And the net book value at that point in time when we sold this computer was 4,352. The net book value simply refers to the economic benefits still available within the business for consumption or revenue generation purposes. Okay, because we still had more value remaining in the computer than what we had actually sold it for, it clearly means we sold it for less than what it had remaining in terms of economic output, right? So therefore, we can confidently say that we have made a loss on disposal, which is simply the difference between the net book value and the amount we've got from selling. So 4352 minus 3,500, which is 852. Okay? So we have already answered the second part of the question, which asks us to calculate the gain or loss. Okay? We have already derived that in addition to the depreciation of 1088. Okay? Now, what about depreciation for the old computer? So we have got two computers, if you recall, from the purchase on 15 September 2014. One of them has already been sold. Now we still have got one more left, which is also going to be depreciated, just simply applying the percentage on the net book value. So 20% multiplied on 5440, which was the net book value we had at the end of year 2. And that would be 1,088, basically the same as what we calculated for the asset which we had sold. Okay. Now, we also bought a new computer, and the cost of the new computer is $10,800, which is given here in the second line of information. And the company's policy requires us to find a full depreciation for this new computer, which is basically 20% multiplied by the cost of 10,800, which is 2,160. Okay? All right. Now, I want to find the numbers. So let's see what's going on. So firstly, my question to you is, how much should we report in the income statement for the amount of depreciation expense for the year ending 31 July 2017? Okay? All right. So in the income statement or the statement of financial performance for the year ending 31 July 2017, the depreciation expense that we will report is 2,160, which refers to the depreciation calculated for the new computer, plus 1,088 for the old computer that was still left behind, and then 1,088 also for the computer which we have sold. And it's same because we know the company requires us to apply a full depreciation in the year of purchase and also in the year of sale. So altogether, the depreciation expense for the year ended 31 July 2017 is 4,336. And this is the amount to be reported as depreciation expense in the statement of financial performance, also known as the income statement. How much should we report for the accumulated depreciation? The accumulated depreciation is something which we report in the statement of financial position or the balance sheet, as you know. So how much will we report for that? It's going to be the total for accumulated depreciation that we had previously at the end of year 2. So I'll just scroll back up, not to break your concentration, just hold it. It's 6,120 if you recall at the end of year 2. All right. So 6,120 plus an additional 4,336. Which is the depreciation that we calculated for this specific financial year of 31 July 2017. So altogether, the accumulated depreciation will come out to be 6,120 plus 4,336. So I'm just going to derive it at the top of my head. So 10,456, if I'm not mistaken. I believe that's correct. 6,000 plus 4,000 is 10,000. And then we've got, yep, that should be correct. 10,456. So this is the amount you'll report in the statement of financial position or the balance sheet. Okay. All right. So if you have got any questions, you can post them down in the comments. And if you found value in this content, make sure to drop a like and subscribe to this channel and share this with your friends. So in the description for underneath this video, you'll find that there is a link to book a free Zoom call. You must bring your parents, and in that Zoom call, we can discuss your monthly coaching requirements to help you prepare for your exams that are happening very soon at the end of the year. And definitely we will help you ace it. So that's all for today's lesson. Make sure to subscribe to this channel and I'll see you in the next video.